OPEC Plus had always given itself the flexibility to adjust the pace of increasing output or actually slowing it down when they had announced their plans for 2025. So in and of itself, that is not necessarily surprising. I think what is more shocking to the market is the fact that we have had two consecutive months now for May and for June, where you'll have these very large increases of more than 400,000 barrels a day, split across really just about 8 members of the Producers Alliance. What is the sort of overt rationale behind it is an effort to try and enforce some production discipline. So one of the big challenges with OPEC Plus and trying to support the market or target prices is that you have to coordinate policy across all those countries. And if some of them are producing more than expected or more than their target levels, that undermines the whole process. And that's been pretty evident, pretty transparent in some of the production estimates that we've seen across OPEC Plus, that overall compliance has been okay. It hasn't been spectacular, and there are some shortcomings there.
Indeed, Ed. So this is ultimately going to mean lower for longer oil prices. The question is how low and for how long? I think market investors are still trying to work that out.
Yeah, and that may have been part of the reason why they actually shifted the meeting a couple of days earlier to not a market day. So they actually made this announcement on Saturday. It was meant to come today. So if they had delivered it while the market was live, we could have seen a really sharp reaction across crude markets as well as across other asset classes. So there might have been an idea that, okay, if we do it over the weekend when nobody is trading, it will give some time for markets to consider the scale of what is happening. But obviously, as we're seeing, in terms of the reaction in the front month, there's been a very negative reaction in terms of pricing, down almost 4% across the Brent and WTI market. Brent now sub $60 a barrel. And then also the shape of the curve has been changing dramatically. So the contango that had been really in place for the end of 2025 and beyond is now shifting closer and closer to the front month.
I spoke with RBC's Halima Croft on Friday. She had an interesting take ahead of the meeting and in a recent note said Saudi Arabia seems to have tired of the free riders and is eager to dispel the notion that it is so committed to higher prices that it will provide endless cover for the non-conformers. And that speaks directly to your point as well, Ed, about how this all ultimately comes back to compliance, not necessarily the price. What is this going to mean for OPEC conformity moving forward, particularly from those countries who still really need to get their act together when it comes to fitting in here and pulling the OPEC line?
Well, we have been warning that OPEC Plus integrity was always a risk, that you could have a disorderly breakdown within the framework, and that you will get a return to an overt market share battle, similar to what we saw in March and April 2020, when everyone produced as much as they could. It was very painful in terms of oil prices collapsing. That was, of course, in the midst of the pandemic, so there were other overriding factors. But the idea that you're not going to have Saudi Arabia providing, as you say, cover for those other producers who are doing too much, I think is becoming increasingly clear. And it will mean that we go through this period of disciplinary price action. So prices being lower, potentially hitting fiscal budgets. When we look across the GCC, for example, we expect most countries will either be running fiscal deficits or very marginal surpluses, like in the case of the UAE. So it will be some fiscal pain, although we don't need to necessarily see much fiscal tightening just yet on the part of Saudi Arabia.
Indeed, and that is where it all comes back as well. This is going to have a significant impact across the GCC, particularly on budgets, as you say. Ed, on another issue here, of course, we are also looking out for the Trump visit, which will take place next week. There'll be plenty of armchair analysts out there who'll say this decision from the group and from Saudi Arabia in particular is in response to Trump's calls for higher output. To that, you say what?
That may be part of the sort of the rationale, the sort of the chain of thinking that's going into the decision making here. It's very clear that that's not the overt rationale behind it. I think maintaining a strong relationship between the United States and Saudi Arabia, and indeed all of the countries across the GCC, still remains a priority for governments across the region. If lower oil prices helps that process, that can be part of it, but we think that's more of an ancillary aspect rather than the primary one.
So, Ed, what should we be looking out for next here as we see oil prices continue to move lower and as the policy continues to evolve as well? Of course, issues like Russia, issues like Iran also have the capacity to add another layer of complexity, perhaps even another layer of supply onto this market moving forward. What's the biggest risk in your view right now?
Yeah, I think what we could see is similar comments to what we had from the Kazakh energy minister a couple of weeks ago, saying that they were committed to higher oil production for the economic benefit of Kazakhstan. And that's a pretty clear indication that the OPEC plus rubric, the framework, is not satisfying all of its members equally. So you could start to see more and more members start to fray at the edges, perhaps even potentially lose. And at that point, it becomes a sort of every country for themselves and production going higher. And as you say, on top of that, there are the idea of what if sanctions are removed on producers like Russia, so it's more freely able to export its oil to its kind of historic core markets across Europe. What if you have sanctions being eased on Iran or on Venezuela? So I think going forward, it is going to be an oil market that is going to have to get used to a lot more oil rather than necessarily one where we're really concerned about near-term tightness of supply.